Hello, this is Mark from tradinform.com and welcome to this video. In this video, I am looking at the Santa Claus Rally, the supposed rise in stock markets at the end of November and December every year. I am going to look about whether this phenomenon actually exists. I'm going to look at if it does, how can you trade it, what is the best way to trade it, how to optimize your trading strategy, and how it works in different markets. Stay tuned. On the screen at the moment is a Tradinform backtest model. This is an Excel-based backtesting system that you can use to backtest all sorts of different trading strategies, different technical indicators, different markets and different time frames. And if you want more information about this, about how you can test and optimize and refine your own trading strategies, there is information. There is a link on the screen at the moment and below this video. Now, what I'm doing today is looking at the market that I'm testing is the SPY ETF. The SPY tracks the S&P 500 index of large cap US stocks. Now, this is a seasonal backtest, so I am testing the Santa Claus Rally and I'm testing it to open in November because we want to be positioned before the start of December. There are good historical reasons for this. So we're entering in the 11th month and we've also got an entry day filter which can be adjusted. So I am showing this at the moment entering at the start of November, on the 1st of November or the next trading day. Now, I've got a few other filters here, but none of them are active, and the exit is the 1st of January. In fact, we're including the 1st of January within the backtest, and again, there are good reasons why. It's usually a good day. So we can see with this very simple strategy, we've got 76% of winning trades. Now I'm going to have a look at the trades that make up this trading strategy. Of course, we only get one a year. So we're looking at here, start of November to the start of January. Now we can see here that when we get the losing trades, these tend to come on the back of volatile years, volatile periods. So we were having .com crash here, start of the financial crisis here, towards the end of the financial crisis, bear market here. We had volatility in 2015. We had a lot of volatility in 2018. So these are the Decembers, the seasonal periods that haven't performed so well. Now, 2020 has been a very unusual year, to put it mildly, so far. So we don't know what we are going to get so far. We do know we've already banked quite a lot of the potential for the seasonal period. So what we will get in December is a big unknown. However, the results still stand for themselves that we have tended to have positive periods in December. Now, going back to the results, we've got a number of filters that we can use here. So first one that I'm going to demonstrate is the long trade filter. Now, this is something I've been looking at for a while. I've mentioned it in a number of my videos. Now, this is the ratio of the ATR to the closing price, which is basically a measure of volatility. So you can see if I put this down here, it's going to change the trading strategy. And how it does that is that anytime the ratio, so the ATR, is 5 times greater than the closing price, suggests a lot of volatility, particularly for this market, then we're going to not take the trade. So it must be below this. And I can restrict it even further. See, our average trade expectancy is decreasing slightly, but really it's not making a big difference. Slight increase in percentage winning trades, but we've got relatively few data points, so we can't read too much into that. However, on the whole, not a bad option if you want to trade in lower volatility situations. Now we can change the entry day. So at the moment I'm including all of November and all of December. We can switch this on and we can see we will be having less net profit and average trade expectancy because the trade is going to be open for less time purely for that reason. So we're not going to read too much into that. We can have a look at the profit factor. which is staying strong, suggesting we've got a large number of winning trades. The aggregate value of winning trades divided by losing trades is still quite high, and we've still got a good average trade expectancy. So I can change the entry day here to 25th of November, 26th, and we can see how it changes the results. It's not such a useful thing to look at drawdown and MAR ratio here, because we're dealing, as I said, with relatively few data points, but it is worth paying attention to and having a look at. So that is slightly higher in this situation, but basically we can see high profit factor, still worth taking the trade from that point of view. Now I'm going to put this back to the 1st of November, and you might well want to include a profit target. This trading strategy is position sizing using the average true range. Now there are swings and roundabouts with either using a percentage base, position sizing and stop loss, and ATR based. Now if you're not familiar with using the ATR, then in this model here all you need to do is check the box here and it will switch to percentage position sizing, which simply means if the underlying market increases or decreases by 10%, that's how much the value of the trade will increase or decrease by. If you use the ATR, then this adjusts for volatility, or at least it adjusts for the average true range. So it means that if volatility or the ATR is relatively low coming into the trade, then you'll have a bigger position size, whereas if volatility is high, then you'll have a relatively small position size. Okay, so we can adjust that. You can put a commission in to make these results valid to your real life trading costs. If you're using commission on entry, commission on exit, if you're trading ETFs, if you want to include a percentage spread, you can easily do that as well. Now, if you want to use a profit target, usually use a profit target to increase our percentage of winning trades and get out when we've already made a decent profit. We can see that there is some merit potentially in using a profit target. A lot of people like to do that, myself included. And we can also adjust it using this MACD filter here. Now it's not making a huge difference here, but if you wait later in the video, I'm going to look at some different markets and we can see that the MACD filter may be of use. He explains what it is here. So the histogram is below 0. Now this simply means that the MACD histogram must be below 0 before a trade is taken. Now if I go back to the trade list, you can see the difference that this makes. So instead of opening on the 1st of November, it's had to wait until the 13th. Likewise here and here, we're opening at a different time. We're waiting for the MACD histogram, which suggests a pullback. I'm going to switch that off. Now we have a few different exits. We can close after a certain number of days. Now this is purely and simply a time close. So if I set that to 5, it would mean that the trade would close after just 5 days. Now, because we've got potentially, we're re-entering here, if I close it after 5 days, we're going to have loads more trades. So there'll be more trading commissions, but it's something to consider. So if I'm going to change that to 10, the trades would stay open for a maximum of 10 days or 10 bars. Maybe something worth considering there. It's a variable that I like to include in my models. Now, strength close simply means that if the trade increases by this minimum value here, 1% on 2 consecutive days or 2 consecutive bars, then the position will close. Not adding a lot of value here, so I'm going to switch that off. Now we can trade the next day open. Simply means instead of taking the closing price, we take the opening price following the close signal. A lot of people prefer to trade using the open price. And we can change the date period. So we can change here to 2010. Give ourselves 10 years worth of data. And we adjust here and we get different values over the past 10 years. Now, as I mentioned earlier, what I'd like to do is test some different markets. Now, there's a new function in the trading form backtest models, and this is an automatic data importer. Now, you need to have the data that you're using here stored. This is where I've got the data stored here on my local computer. And I'm using the SPY, so I can easily switch that. Let's have a look at IWM, which is a emerging markets ETF, very popular one. And we can see with exactly the same settings, we get very similar results. Maybe this is a bit more volatile on the SPY. In fact, it's very similar indeed, which is interesting. And we can have a look at the QQQ, another one of my favorites. QQQ, of course, tracks the Nasdaq 100 index. Tends to be more volatile, tends to have more momentum properties. Again, we're getting pretty similar results here. Long trade filter is definitely kicking in for the QQQ. See that has an effect. And let's have a look at some others. Okay, so we've looked at IWM, feeder below, the Vanguard version of the S&P 500 tracker. Unsurprising, although only started in 2010, we're showing some pretty similar results with that one. Always worth checking if we can do so very quickly. And XLV, which is healthcare stocks ETF tracker. You can see the advantage of this is we can very quickly test different markets. Now again, we're getting pretty similar there again. So let's put this down to 5 again. Gives us more data points, but does not give us any higher net profit. So not really much use doing that. And we can test individual stocks here. So we can strongly expect Amazon to be affected by the Santa Claus Rally, the big daddy of retail stocks these days. Decent percentage of winning trades, nothing spectacular. Let's push this higher. Okay, yeah, nothing spectacular, but still pretty decent. And let's have a look at Google. So there we go, there's Google. So we can test exactly the same thing. All of these showing pretty similar results, which is not to say every market will do, but we've got some fairly consistent results over a number of markets here. So I hope you like this video. If you do, please hit the like button. Please remember to subscribe to this channel for more content like this. And if you would like more information about trading the financial markets, backtesting your trading strategies, getting better trading results, please go to tradinginformed.com.